Your money doesn't live where you think it does. You might believe it sits safely in your bank, backed by deposits and regulated by government agencies designed to protect you. But most of the financial system that determines interest rates, credit availability, and ultimately whether the economy functions or collapses operates somewhere else entirely. Somewhere beyond regulations, beyond deposit insurance, beyond the oversight that's supposed to keep the system safe. It's called shadow banking. And it's not a conspiracy theory or a fringe operation. It's a parallel financial universe larger than the traditional banking system, handling trillions of dollars every day, invisible to most people but fundamental to how modern money works. And when shadow banking breaks, as it did in 2008 and threatens to do again, it doesn't just affect Wall Street traders or hedge fund managers. It destroys jobs, evaporates savings, and crashes economies. Understanding shadow banking means understanding that the financial system isn't what you were taught in school, that most money moves through institutions you've never heard of, and that the next crisis is being incubated right now in markets operating just beyond the reach of public accountability. Shadow banking didn't emerge from criminal enterprise or regulatory evasion, at least not initially. It evolved from legitimate financial innovations designed to solve real problems. To understand how, we need to go back to traditional banking and see what it actually does. A bank takes deposits from customers, paying modest interest, maybe 1–2%. It then lends those deposits to borrowers at higher rates, perhaps 5 to 7% for mortgages or business loans. The difference between what the bank pays depositors and what it charges borrowers is profit. Simple enough. But banks face constraints. They must hold capital reserves, typically around 10% of deposits, meaning they can't lend everything. They're subject to regulations limiting what they can invest in and how much risk they can take. And they're covered by deposit insurance, which protects depositors, but also means government oversight to ensure banks don't gamble with insured funds. These constraints exist for good reasons, learned through centuries of bank failures and financial panics. But constraints also limit profit. If you're a financial institution and you want higher returns than traditional banking allows, you need to operate differently. You need to escape the regulations, avoid the capital requirements, and take risks that traditional banks can't. Enter shadow banking. The term was coined in 2007 by economist Paul McCulley to describe the network of financial institutions that performed bank-like functions, taking short-term funding and lending long-term, but operated outside the traditional banking regulatory framework. Money market funds, hedge funds, investment banks, special-purpose vehicles, and an alphabet soup of other entities that did what banks did, but weren't technically banks and therefore weren't regulated like banks. The growth of shadow banking accelerated in the 1980s and exploded in the 1990s and 2000s. Several factors drove this expansion. First, financial deregulation removed many of the barriers that had separated different types of financial institutions. The Glass-Steagall Act, passed during the Great Depression to separate commercial banking from investment banking, was repealed in 1999. This allowed banks to engage in riskier activities they'd been barred from for 70 years. Second, financial innovation created complex new instruments and structures that existing regulations didn't cover. Derivatives, securitization, collateralized debt obligations. These weren't traditional loans or deposits, so the rules governing traditional banking didn't clearly apply. And third, globalization meant money could flow to wherever regulations were weakest. If the US tightened rules, operations moved to London. If Europe imposed restrictions, capital shifted to Caribbean tax havens or Asian financial centers. The core mechanism of shadow banking is the repo market, short for repurchase agreement. This is where the shadow system gets its funding, the equivalent of deposits in traditional banking. Here's how it works. A financial institution holding securities, say government bonds or mortgage-backed securities, needs cash. It sells those securities to another institution with an agreement to buy them back the next day or week at a slightly higher price. The difference between the sale and repurchase price is effectively interest. This happens billions of times daily with trillions of dollars changing hands. The repo market is how shadow banks fund themselves short-term, using securities as collateral to borrow cash they'll repay when the repo matures. On the surface, repos seem safe. They're backed by collateral, unlike traditional loans. If the borrower defaults, the lender keeps the securities. But repos have hidden fragility. They're overnight or very short-term, meaning they must be constantly renewed. If lenders lose confidence and refuse to roll over repos, borrowers face immediate funding crisis. They can't pay back maturing repos without taking out new ones. And if everyone's trying to sell securities simultaneously to raise cash, prices collapse, which means the collateral backing repos loses value, which makes lenders even less willing to lend. This is called a run, just like a bank run, except it happens in the repo market where almost nobody outside finance even knows it exists. Money market funds are another pillar of shadow banking, and one that touches ordinary people directly. These funds promise deposit-like safety, they maintain stable $1 per share value, and offer slightly higher returns than bank deposits. Millions of people and corporations park cash in money market funds, believing they're as safe as banks. But money market funds aren't banks. They're not covered by deposit insurance. And they invest in short-term commercial paper and other instruments that carry risk, however small. Most of the time this works fine. But when markets panic and the instruments money market funds hold lose value, the funds can break the buck, meaning share value drops below $1. When that happens, investors rush to withdraw money before losses mount, creating a run that can destroy the fund and spread panic throughout the financial system. This happened in September 2008 with the Reserve Primary Fund, a major money market fund that held commercial paper issued by Lehman Brothers. When Lehman collapsed, that paper became worthless. The fund's value dropped to 97 cents per share, breaking the buck for only the second time in money market fund history. Investors panicked and tried to withdraw $230 billion from money market funds in a single week. If not stopped, this run would have frozen the commercial paper market, meaning corporations couldn't borrow for day-to-day operations like meeting payroll. The government stepped in with emergency guarantees, effectively bailing out money market funds to prevent total economic collapse. The crisis revealed that institutions millions of Americans believed were safe, as banks were actually shadow banking entities one panic away from destruction. Hedge funds represent another shadow banking component, though their role is more complex. Unlike traditional banks that take deposits, hedge funds pool money from wealthy investors and institutions to make aggressive bets in financial markets. They use leverage, borrowing multiple times their capital to magnify returns. A fund with $1 billion might borrow $4 billion more, controlling $5 billion in investments. When bets work, returns are spectacular. When they fail, losses are catastrophic. And because hedge funds are interconnected with traditional banks through loans and counterparty relationships, their failures can spread. Long-term capital management's collapse in 1998 required a Federal Reserve orchestrated bailout because the fund's positions were so large and so interconnected that its failure threatened to cascade through the financial system. LTCM wasn't even the largest hedge fund. It was just so leveraged and so entangled with major banks that its death would have taken others down. Special purpose vehicles and structured investment vehicles are the truly shadowy parts of shadow banking, entities created specifically to hold assets off balance sheet. Banks would create these vehicles, transfer loans or securities to them, and then issue new securities backed by those underlying assets. This process, called securitization, allowed banks to move risk off their books while still earning fees. The bank originates a mortgage, sells it to a special purpose vehicle, which bundles it with thousands of other mortgages and issues mortgage-backed securities sold to investors. The bank gets its money back immediately and can issue more mortgages. The risk theoretically transfers to investors who bought the securities, but the complexity of these structures meant nobody really understood where risk resided. A single mortgage might be bundled into a mortgage-backed security, which was then sliced into tranches with different risk levels, which were then bundled again into collateralized debt obligations, which might be insured through credit default swaps, which created exposures for insurance companies and banks that sold those swaps. The chain of obligations became so convoluted that when mortgages started defaulting in 2007, nobody could figure out who owed what to whom or which institutions were exposed. The opacity was a feature, not a bug. Complexity allowed banks to claim they'd reduced risk when they'd actually just hidden it in structures too complicated for regulators or investors to analyze. The 2008 financial crisis was fundamentally a shadow banking crisis. The trigger was subprime mortgages, risky loans issued to borrowers with poor credit. But traditional banks didn't hold most of those mortgages. They'd been securitized, bundled into mortgage-backed securities held by investment banks, hedge funds, pension funds, and shadow banking entities around the world. When housing prices stopped rising and borrowers began defaulting, the securities lost value. Suddenly, the collateral backing repo markets was worth less than believed. Lenders stopped rolling over repos, demanding more collateral, or refusing to lend at all. Shadow banks couldn't fund themselves. Bear Stearns, the first major casualty, collapsed in March 2008 not because it was insolvent by traditional measures, but because it couldn't roll over its overnight repo funding. Lehman Brothers followed in September, the largest bankruptcy in American history. Lehman was an investment bank, technically not a bank at all, but a securities firm, part of the shadow banking system. It funded itself through repos and commercial paper, borrowing short-term to hold long-term assets, the classic bank maturity mismatch. When confidence evaporated, Lehman couldn't refinance maturing obligations. Within days, it was gone. And its collapse triggered panic throughout shadow banking. Money market funds broke the buck, the commercial paper market froze, the repo market seized up, credit vanished. Banks stopped lending to each other or to businesses. And the real economy, the world of jobs and production, ground to a halt because the financial plumbing had failed. The government response was unprecedented. The Federal Reserve created emergency lending facilities with names like the Term Auction Facility, Primary Dealer Credit Facility, and Commercial Paper Funding Facility. These programs loaned trillions to financial institutions, both banks and shadow banks, to prevent total collapse. The Treasury Department guaranteed money market funds. Congress authorized $700 billion for the Troubled Asset Relief Program, TARP, to buy toxic assets and inject capital into failing institutions. In total, the government committed over $7 trillion in loans, guarantees, and purchases to stabilize the financial system. Most of it was eventually repaid, but the message was clear. Shadow banking was too big to fail, and the government would bail it out using taxpayer money when crisis came. The post-crisis reforms were supposed to fix this. The Dodd-Frank Act passed in 2010 increased regulation of large financial institutions, created new capital requirements, and established procedures for winding down failing firms without taxpayer bailouts. But shadow banking adapted. It moved further into the shadows, into corners of the financial system less regulated or not regulated at all. Private equity funds grew exponentially, buying up companies with borrowed money. Non-bank lenders, fintech companies, and online platforms filled lending niches that banks abandoned. And the repo market, rather than shrinking, grew even larger, now estimated at $4 or $5 trillion daily in the US alone. China's shadow banking system became perhaps the world's largest. A parallel financial universe where state-controlled banks moved risky loans off balance sheet into wealth management products sold to ordinary citizens who believed they were safe as deposits. When some of these products failed, revealing losses, the Chinese government faced a choice: let shadow banks fail and risk social unrest, or bail them out and encourage more risk-taking. They chose bailouts, guaranteeing that shadow banking would continue to expand, carrying risks that grow larger every year. The pandemic brought another shadow banking crisis that almost nobody noticed because it happened so fast and was resolved so dramatically. In March 2020, as COVID lockdowns began, markets panicked. Investors tried to convert everything to cash simultaneously. Corporate bonds crashed. Even treasury bonds, supposedly the safest assets in the world, saw prices plunge as leveraged investors were forced to sell. The repo market spiked, with overnight interest rates jumping to 5% from near zero. Hedge funds and other leveraged players faced margin calls demanding more collateral immediately. The system was hours from seizing up completely, which would have meant no one could borrow, credit would vanish, and the economy would suffer damage far exceeding the pandemic itself. The Federal Reserve intervened with blinding speed, announcing unlimited quantitative easing, meaning it would buy unlimited quantities of treasuries and mortgage-backed securities to stabilize prices. It reactivated emergency lending facilities from 2008 and created new ones. It extended loans to hedge funds and foreign central banks. Within days, the Fed had committed trillions and markets stabilized. Most people never realized how close the system came to collapse because the intervention was so fast and so massive. But the episode revealed that shadow banking hadn't been fixed after 2008. It had grown larger and more fragile, dependent on continuous Fed support to avoid crisis. The fundamental problem with shadow banking is that it performs essential functions, maturity transformation, credit allocation, liquidity provision, but does so without the safeguards that traditional banking has. Banks have capital requirements, deposit insurance, access to Fed lending, and regulatory oversight because bank failures destroy economies. Shadow banks perform the same functions, but with none of those protections, which means they're vulnerable to runs and panic. And when they fail, governments face an impossible choice: let them collapse and watch the economy implode, or bail them out with taxpayer money and reward the risk-taking that caused the crisis. Why does shadow banking exist if it's so dangerous? Because it's profitable. Shadow banks can operate with higher leverage than traditional banks, meaning they can make bigger bets with less capital. They can take risks that regulated banks can't, and they can avoid capital requirements and oversight that cut into profits. For financial institutions, shadow banking offers higher returns. For governments, it offers growth and credit without the political difficulties of expanding traditional banking regulation. And for borrowers, it offers us credit that regulated banks might not provide. Everyone benefits until the day it all collapses, and then the costs are socialized while the profits remain private. Ordinary people interface with shadow banking constantly without realizing it. When you invest in a money market fund, you're in shadow banking. When your pension fund buys mortgage-backed securities, it's participating in shadow banking. When your company issues commercial paper to manage cash flow, it's using shadow banking. And when the next crisis comes, when repo markets freeze or money market funds break the buck or hedge funds collapse under leverage, your retirement savings will vanish, your job will disappear, and you'll bear the costs of a system you never chose to participate in and probably didn't even know existed. The size of shadow banking is staggering. Global shadow banking assets exceed $200 trillion, roughly equal to global GDP and larger than the entire traditional banking system. In the United States, shadow banking represents over 150% of GDP. China's shadow banking is estimated at 80% of its GDP. And these numbers may understate reality because shadow banking, by definition, operates in shadows where measurement is difficult and reporting is sparse. The system that controls your money, that determines whether credit flows or freezes, that decides if the economy grows or crashes, is larger than the visible banking system and operates with a fraction of the oversight. The regulators know this. Central bankers and financial authorities understand that shadow banking poses systemic risk. They've written reports, held conferences, and proposed reforms. But shadow banking is difficult to regulate because it's diffuse, operating through multiple entities across jurisdictions. What looks like excessive risk from a systemic perspective looks like profitable innovation from an individual firm's perspective. And the lobbying power of the financial industry ensures that regulations remain weak, implementation is slow, and loopholes remain exploitable. After every crisis, there are calls for fundamental reform. And after every crisis, reforms are watered down, delayed, or circumvented. The next crisis will come from shadow banking. Maybe it will be corporate debt, which has exploded in the post-2008 low-interest rate environment, much of it held by leveraged funds vulnerable to runs. Maybe it will be repo markets freezing again when collateral quality is questioned. Maybe it will be crypto assets and decentralized finance, new forms of shadow banking operating with even less regulation than traditional shadow banks. Or maybe it will be something nobody's watching, some corner of the financial system where leverage has built up invisibly until it breaks. The only certainty is that the crisis will come, that it will spread from shadow banking into the real economy, and that ordinary people will pay the price while the institutions that caused it will be bailed out because they're too important to fail. The shadow banking system that controls your money isn't an accident or a natural evolution. It's the result of deliberate choices by institutions seeking higher returns and regulators unwilling or unable to constrain them. It's a parallel financial universe where the rules that protect ordinary savers don't apply, but where failures still destroy ordinary lives. And it's growing larger every year, expanding into new markets and creating new forms of risk that won't be understood until they've already detonated. Understanding shadow banking means recognizing that the financial system operates on two levels. The visible level, banks and regulations and deposit insurance, provides a comforting illusion of safety and oversight. But the real action happens below, in shadow markets where trillions move daily, where leverage multiplies risk, and where the next crisis is always incubating. Your money is controlled not by institutions you can see or regulators you can hold accountable, but by a system that operates in shadows by design, that profits from opacity, and that will demand rescue when it fails while never truly being reformed. If this gave you a new perspective, hit subscribe. History doesn't repeat, but financial crises always do. And the next one is hiding in the shadows right now, waiting for the moment to emerge into the light and show everyone just how much control they never had.